Why do markets not like tariffs? Because they essentially make the smooth running of a global market much more difficult. So they are a kind of deglobalizing force. And you could argue that globalization has been a driver of economic growth for decades. And it appears that we're now moving into, there's been a reversal of that process.
Hello, everyone, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm joined today by Tom Stevenson, Investment Director here at Fidelity, to talk about the re-emergence of tariffs and the potential threat that poses for markets, which entered the year pretty close to all-time highs. Before all of that, let me remind you that if you find this video useful or interesting, to please subscribe to the channel, give us a like, join the discussion in the comments below. It really does help others find what we're doing here, and it means that you'll get new content as soon as it is released. That all said, Tom, welcome along. How are you?
I'm very well, thanks, Ed.
A lot of the issues we're going to talk about today have been rumbling in the background for quite a while, most of last year, really. But things escalated over this past weekend. So what happened?
Yeah, so this is all about an escalation of the trade war, the tariff situation, which really kicked off in earnest last April, as we know, with the imposition of those widespread tariffs around the world. I think what's different about what happened this weekend is that this is a change in the way that tariffs are being used. In other words, they're being used for not obviously economic ends. They're being used apparently as leverage in a kind of geostrategic dispute. So Greenland. And so I think that's an important change in the way tariffs are being used. Specifically, what happened was that on Saturday night, Donald Trump announced that he was going to impose a 10% tariff on a number of countries, including the UK, countries which had taken part in a military exercise in Greenland. So a lot of European countries, Norway, Germany, France, Finland, and others. 10% tariff to be implemented from the 1st of February, escalating to a 25% tariff from the 1st of June if there were no, essentially if those countries had not stepped into line behind Donald Trump's stated aim to take control of Greenland.
Yeah, this is going to be changing day by day, isn't it? There's lots of discussions at Davos.
Yeah, and it has developed even this week. I mean, since Saturday, what we're talking about now is the response from European countries. They are dusting off plans which were actually put together last year during the initial tariff situation, plans to impose retaliatory tariffs on the US, up to 93 billion euros worth of tariffs, and also possibly what they call anti-coercion initiatives. I don't think that's the right word, but anyway, it measures which basically shut the US out from participating, selling to the European bloc.
Yeah, none of this sounds good. It's less than a year since we had the emergence of tariffs as an issue last year. There was a very sudden but ultimately quite a short-lived correction in markets. Actually, a bear market, technically, wasn't it? A drop of 20%. What's been the reaction of stocks this time? Now, I say this with the rather large caveat that we're talking a few hours before the US market opens. It's been closed since Friday.
That's right, yeah. So Martin Luther King Day yesterday, so the US market was closed. So we've had to wait a bit longer than we would have done to see what the US market reaction would be. We have a fairly clear sense. You can get a sense from the futures markets what is likely to happen in the US, and what we expect to happen is that there will be a fall in markets, in stock markets, just as there has been in Asian and particularly European stock markets, which have fallen, between 1% and 2% over the last 2 days, Monday, Tuesday. So I think we'll see lower markets when the US opens, and that's a natural response to increased uncertainty. It's a natural response to a real sort of economic impact. If the tariffs are implemented, but also it's a risk-off response to increased uncertainty.
Yeah, and the word on the bond markets, which have been moving as well. Lots of bonds, government bonds all over the world, yields rising.
Yes, and that is a response again to increased uncertainty. Particularly, it's also a response to investors having second thoughts really about their exposure to the US market. And, a lot of overseas investors' exposure to the US is through the treasury market, the government bond market. So, if there is a sell-off, and there has been some talk, and I think this may be exaggerated, but there has been some talk about European countries using their holdings of treasuries, which are very extensive, as some kind of leverage in this this dispute. So that's creating the uncertainty around bonds and pushing yields up, which, as we know, has the impact of pushing prices down.
Yeah, and just in case anyone is still unclear, why would markets dislike tariffs, Tom, and who ultimately pays the price of them? Actually, just hearing you talk there, you just realize how interconnected economically the world is. We all own each other's debts. We all provide each other's markets, for businesses. This is messy.
And I think that is the answer to the question: why do markets not like tariffs? They dislike tariffs because they essentially make the smooth running of a global market much more difficult. So they're a kind of deglobalizing force, and you could argue that globalization has been a driver of economic growth for decades, and it appears that we're now moving into, there's been a reversal of that process. But broadly speaking, why do markets dislike tariffs? They're bad for growth. They're bad for company profitability. They can act essentially as a tax on consumers, which means they have less to spend. So that's bad for growth and company profits. They can be inflationary because they raise the cost of imported, end products, but also, commodities and things which go into
component
parts. Thank you. Yeah.
Okay. Well, so that all said, do you think that the market reaction, obviously we've had some of it, but do you think the market reaction this time is likely to be more muted than we saw last year? Just to recap what happened last April, really, really sharp fall. We were seeing, a 20% fall in the US stock market, I think, over just a few days and weeks, right? And then...
Yes, I mean, to be fair, a lot of that 20% fall happened before the announcement of tariffs, but it was related to the uncertainty around the tariff situation. But yes, markets fell by about 20% between February and, literally a few days after the announcement of the tariffs in April. And then markets turned around very quickly. And I think the reason why they turned around quickly was that it became clear to investors that tariffs are not really a short-term shock. They're a sort of slow burn impact on growth. So that was kind of discounted. And the second reason was that markets quite quickly realized that the tariffs were essentially a bargaining chip. They were a negotiating ploy to a large extent, and that meant that there was room for compromise and renegotiation, which indeed is what happened. The tariffs that we ended up with at the end of the year, we haven't ended up with them there because the process is still ongoing. But the process, the tariffs that we're heading towards or already have, are very different from the ones that were announced in April, and that's been reflected in the market. And
because of that experience last year, do you think this time markets will be more confident or less questioning of the most sort of dire outcomes, because ultimately they didn't truly come to pass last time? The most dire predictions for tariffs didn't happen. Do you think markets now have a certain confidence that they can somewhat disregard the worst sort of predictions?
Yes and no. I think that is an optimistic reading of the situation. I think there's a grain of truth in that, because clearly things didn't pan out as badly as people feared at the outset. I do think, though, it's important to recognise that The market situation is different today. Markets have gone up a lot. So they are vulnerable in as much as they are more expensive than they were at the time of the announcement of the tariffs. And I think it's also important just to come back to that initial point that we made about how this is not just an escalation of trade wars, but it's a change in the nature of the use of tariffs. So the fact that they're being used not specifically for economic ends, but for leverage in a geopolitical, geostrategic sense, I think increases the need for investors to have some kind of compensation for uncertainty, for risk, for policy risk, uncertainty in the markets, which I think was not quite so clear back in April when it was specifically an economic issue.
Okay, well, if the the reaction in stock markets is still becoming clear, there has been quite a large reaction in other assets, gold and silver in particular, and other sort of haven assets. What is that telling us?
Well, it's telling us what we've just been discussing, which is that this increased uncertainty premium, if you like, and gold and silver are typically seen as protection, as a hedge against uncertainty in markets. They're also seen as a protection against inflation, and as we've discussed, tariffs, have a tendency to be inflationary. So I think there are a number of different reasons coming together, coalescing to make the case for gold and silver, which was already quite strong for other unrelated reasons.
Yeah, and it kind of brings us to how investors should sort of approach all this. I'm really conscious in a discussion like this, Tom, that the markets fall and we say, well, wouldn't it have been great to be sort of perfectly diversified going into all this? And that's, of course, impossible. And it's only with hindsight that you can get to say that. However, I think we should indulge a little bit of that this time, because I think you, Tom, have been saying for most of the last year that following the episode in April and tariffs and the big falls we saw, investors got a bit of a second chance to reassess. They recovered those losses really quickly. It was a nasty shock, but actually it was a great reminder for everyone to be not overexposed to the riskiest parts of the market. That really would have been good advice.
It would have been good advice. I do think the market does routinely provide these second opportunities, and it's incumbent on us to take advantage of those. That very often after a drop, the markets do bounce back, and one temptation is to say, "Oh, phew, I got away with it," and carry on without sort of thinking about your process, or it is to take advantage of that and to say, right, okay, we're back to where we were. We're back to square one. What might I do differently this time? And what I say, and what I've been saying really for the last year, is that, one of the best protections against an uncertain, a fragmented world in which we now clearly live, and one where, the rules that we thought that we were living by have to an extent been torn up. In that much more difficult environment, one of the protections is diversification, geographical diversification, but also, via asset classes. And I'm not just talking about, having some bonds in your portfolio because they move differently from shares, because actually, in the last 2 or 3 years, they've actually moved. The correlations, to use the jargon, have been positive. They've moved, shares and bonds have moved in the same direction. So actually that diversification aspect of bonds is less pronounced than it has been. So actually you need to work quite hard now. You need to look more broadly to get that diversification. Gold and silver is one way of doing it, but there are other things that you might want to consider.
All this would indicate, would it not, that it's going to be a good time, notwithstanding getting your portfolio diversified, it might be a good time to slightly tune out of the day-to-day noise. We're going to get bombarded with lots and lots of sometimes alarming news, and markets might react to that. But the lesson almost always is that it pays to stay the course, right?
Yes, in the very long run, it does. I would caution against tuning out the noise completely at the moment. I've just this morning was looking at Bank of America does a monthly fund manager survey, which is a sort of takes the pulse of the mood among institutional professional fund managers. It is incredibly bullish at the moment, incredibly sort of relaxed and sanguine about what's going on in the world. Investors are doing precisely what you've just said. They are tuning out the noise. They're saying, look, the economy is in good shape, interest rates are coming down, I'm all in on equities, and that slightly concerns me. I think that now is a time actually not to tune out the noise, but to be aware of the noise and to think about how to put some protections in place in terms of the diversification we've talked about. Because I do think that, given the level of markets, the high level of markets, and the uncertainty that's around, I think this is a time to err on the side of caution.
Fair enough. Okay, Tom, we've covered loads there. We'll leave it for now. I will just remind you all that if you found this useful or interesting, to please subscribe to the channel. It means you'll get updated content as soon as it is released. Give us a like or share the episodes. It really does help people find what we're doing here. That all said, Tom, thanks so much for joining me.
Thanks, Ed.